Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Market sentiment is essentially the overall attitude of investors and traders toward a particular market or asset. It reflects the collective mood, whether optimistic or pessimistic. Understanding this mood is really important for anyone looking to make informed trading decisions. Ignoring market sentiment means missing a key piece of the puzzle. It helps you see beyond basic numbers and understand the human element driving prices. That insight can give you an edge, helping you fine-tune your strategies whether you're buying or selling. Knowing how the crowd feels can often predict future market moves. Understanding market sentiment, beyond price action. Market sentiment represents the collective attitude of investors toward a specific security or the broader financial market. It's the psychological state of the market, which can swing between optimism, bullish, pessimism, bearish, or indifference, neutral. While price action shows you what is happening, understanding sentiment helps you grasp why it's happening, giving you a fuller picture than just charts alone. Qualitative indicators of market sentiment. Qualitative indicators help us understand the narratives and general feeling driving the market. We look beyond numbers to hear the stories and opinions that shape investor behavior. Consider these factors. News headlines. Major news events, whether economic, political, or company-specific, can instantly shift the market's mood. Positive news often fuels optimism, while negative news can trigger fear. Social media trends. Platforms like Twitter and Reddit are real-time barometers of public opinion. Tracking discussions and trending topics can show you what retail investors are thinking and feeling about certain assets. Expert opinions. Insights from prominent analysts, economists, and fund managers often influence how others perceive the market. Their forecasts and commentaries can sway sentiment significantly. Economic reports. Reports like GDP growth, inflation rates, and employment figures paint a picture of economic health. The market reacts to these reports, forming widespread opinions about the future. These qualitative factors build the underlying narrative, influencing how people interpret data and make decisions. Quantitative indicators for measuring market sentiment. Quantitative indicators offer measurable data points that help us gauge market psychology. These tools provide a more objective view by tracking specific market actions. Here's how some key indicators work. Put-call ratio, PCR. This ratio compares the volume of put options, bets on a price decline, to call options, bets on a price increase. A high PCR indicates more put buying, suggesting bearish sentiment, while a low PCR shows more call buying, pointing to bullishness. Volatility Index, VIX. Often called the Fear Index, the VIX measures the market's expectation of future volatility based on S&P 500 options. High VIX values suggest increased fear and uncertainty, while low values indicate calm markets and less anticipated risk. Advanced Decline Line, AD line. This indicator tracks the difference between the number of advancing stocks and declining stocks over time. A rising AD line shows more stocks gaining than losing, signaling broad market strength. A falling AD line suggests weakness. Commitment of Traders, COT, report. Published weekly by the CFTC, this report reveals the positions of different market participants, commercial hedgers, large speculators, small speculators, in futures markets. It can highlight shifts in sentiment among major players, providing insights into potential trend reversals. These numbers give us a concrete way to see if the market is leaning optimistic or pessimistic. The role of behavioral finance in sentiment analysis. Behavioral finance connects market sentiment to human psychology. It helps us understand why investors often act in irrational ways, leading to significant shifts in market mood. Think about these common behavioral traits. Herd mentality. People tend to follow the crowd, especially during periods of strong market moves. If everyone is buying, others often jump in, fearing they will miss out. Fear and greed. These fundamental emotions drive many investment decisions. Greed can lead to over-optimism and speculative bubbles, while fear can trigger panic selling and market crashes. Cognitive biases. These mental shortcuts can distort our judgment. Confirmation bias. We tend to seek out information that confirms our existing beliefs, ignoring contradictory evidence. If you believe the market will rise, you might only notice positive news. Anchoring. We often fixate on the first piece of information we receive, even if it's no longer relevant. An initial price point, for instance, can heavily influence our perception of value later on. These human elements play a huge role in how sentiment develops and shifts. Understanding them helps you make more rational decisions, even when the market feels chaotic. Developing trading strategies based on market sentiment. Now that we understand how to read market sentiment, let's look at how we can use it to build strong trading strategies. Sentiment isn't a standalone tool. It works best when combined with other types of analysis, like technical or fundamental data. Thinking of sentiment as another layer of confirmation or a warning sign can help you make smarter decisions and better manage your risk. Contrarian trading strategies. Contrarian trading strategies involve going against the popular market mood. When the crowd is extremely optimistic, a contrarian might look to sell. When fear grips the market, they might see a buying opportunity. This approach profits when sentiment reaches an extreme and then reverses. Here's why a contrarian approach can be profitable. Buying during extreme fear. When everyone is panicking and selling, asset prices often drop below their true value. A contrarian steps in to buy, knowing that fear often leads to oversold markets which tend to bounce back. Selling during irrational exuberance. When the market is overly optimistic, prices can become inflated. Traders might buy assets driven by hype rather than fundamentals. A contrarian sees this as a chance to sell, anticipating a correction. A classic example is buying during major market crashes, when fear is at its peak. Similarly, selling an asset after an intense, speculative rally can be a contrarian move. It's about recognizing when the herd is likely to be wrong. You've seen how market sentiment can set the tone for trading opportunities. But knowing the mood is only half the battle. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.